Okay, so thank you all again, and I want to say thanks again to our 4 excellent presenters who brought really interesting perspective around a common theme. So I'll start today. What I'm going to do is I'm going to begin with some specific comments on each of the papers, and then at the end I'll turn to a couple of broader themes and a couple of questions. Okay, so first I need to say my standard disclaimer, which is very important to emphasize. The views expressed here are my own and do not necessarily represent the views of the Federal Reserve Board of Governors, the Fed system, or its staff. So be forewarned. Okay. So looking at Mike and his co-author's paper on CEO succession and performance. So I've heard the theme of succession show up in a number of our sessions here, and a couple of the other papers, and in a number of places among the community bank leaders who are sharing their perspectives here. So their key finding is that CEO replacement at rural banks relative to urban banks does not appear to cause declines in the performance measures that they took a look at. And so one of the questions that I was left with is, so this is a focus on the sustainability of the skilled labor and the leadership at community banks. It's a little different from a focus on migration of customers to other institutions. So I thought this is an interesting and new question, or way to approach a question. So I guess I was curious to know if you would say, Mike, that we could think of, is this actually saying something about maybe it's not such a problem, maybe CEO succession is a challenge, but maybe talent that remains at a bank is not as much of a problem, or you mentioned some of the sample selection that you did. I might like to hear more about that, so I can understand sort of what the inferences are about how dire the succession problem is from the perspective of skill and talent. And I hope we can discuss that at the end. And I was wondering, does this bring us to the question of do we think of talent as being kind of a fixed thing that a person has, or can we think a little harder, particularly in the community context, and think about long-term practices and programs for training, learning, and development? And the example of the competition team from Eastern Kentucky University yesterday I found very inspiring to think about sustainable leadership in a community banking space as being done by a number of collaborative institutions, including universities and community banks and supervisors and regulators. So food for thought. And then if we are going to think about growing talent in community banks as something that's within our control, it actually fits in with a lot of new behavioral psychology research on growth and learning. So it could be that we'll find leadership in ways and from places that we may not expect it if we think about investment in skill and talent as something that we want to foster on a broader scale. So thank you again, Mike, for that, for your perspective, and I'm interested to hear your thoughts. So moving to Bob's paper with his colleagues on stress testing at community banks. So his key contribution, as I read it, was that the authors have created a top-down stress testing model that's been specifically developed for the community banking sector. And what's really nice is that it uses public data. So that's it's transparent, it's reproducible, and it's salient. It offers community banks themselves to analyze risks. And so around this, I have a couple of questions. For one thing, it could be useful for researchers and for supervisors as well, because you can look at a large set of institutions using a common model and look at horizontal effects broadly and cyclically. So I thought that was a point that could be emphasized even more. One question is this a tool that will be compelling for leaders of community banks? Is this the type of model, is this the type of application that would be useful to all our colleagues here? I asked Bob and and Joe, is there an app for that? How would it be possible to make a low-cost version that doesn't involve a lot, doesn't involve a lot of iteration with you or Joe, or not that that's bad. I'm sure that would be a wonderful collaborative experience. But is there a plug-and-play version that could be designed where an institution could, put in some key financials and crank it through? Also, what about alternate scenarios? Could banks themselves kind of, tweak the scenarios to be something that they, from their perspective, see as more realistic, particularly regionally for them? And then another question I had was, would you plan to update this? Would this be something that were permanent over time when the new stress scenarios are released by the supervisor each year? So I thought it was a really useful exercise. It was really, really interesting to learn about. So I'd be interested to hear your thoughts on that. So Louis, now we come to your talk, and I used the word provocative intentionally because I had all kinds of questions, and I think in some sense it's super brave to go out and think about these types of questions that are not purely based on what we think of as financial decision making, and bring some of the human element in. So I enjoyed that. I also actually enjoyed it from an economics perspective. The sleeves rolled up data work that you did to get this information together. And for those who are more involved in the day-to-day practice of banking and less involved in the research on banking, it's often really hard to find things that are exogenous and outside the control of individual bank leadership. And where one is born is pretty much, for sure, outside of one's own control. So I congratulate you on finding a truly exogenous factor. Okay, so the key findings here, there's evidence that the authors propose of favoritism bias, where banks are lending more, opening more branches near the CEO's birthplace. The favoritism appears to be stronger among what they describe as altruistic, and I do put that in quotes because I want to hear more about how you think about that, in struggling areas and for marginal mortgage applicants. And as Louis mentioned at the beginning of his talk, these are really important questions in terms of how credit is allocated in the economy. So from an economist perspective, I think the canonical question is credit allocated to its most productive use? When we think about its most productive use, I think we have to be careful about exactly what we mean, because there can be positive external effects in a local community that could go far beyond the immediate recipient of credit. So I think that's an interesting area for us to think about. So the finding here was that in the home community, there was more generous credit provided to what I guess I would think of as a conventionally underserved population, or underserved populations. And so I wanted to know, was this surprising to you? Because I wasn't sure. You had said that it was an indicator of something that isn't informational advantage. So you see, this was not in support of informational advantage or relationship lending. And I was wondering if it might actually not be inconsistent if there is a systematic difference in the available amount of observable information of people who may have shorter credit histories or may have less observable ways to demonstrate their credit worthiness. So I guess I would push back a little bit on that takeaway. And then I was also a little curious about, so the borrowers, the finding was that the borrowers in markets that were close to the CEO's birthplace received disproportionately more generous credit. And so I wanted to know a little bit more about where that was coming from. So who are the borrowers that were not getting the credit? And you did discuss this in the paper, but I would be curious to know, it's not a free lunch, and you're not proposing it's a free lunch, it's more like a relocated lunch, like who moved my cheese from one market to another. But I think it would be very interesting to know what is the impact and what is the distribution of the impact. Is it that credit is moved from areas that are, from one particular market to another, a home bias market, or is it drawn kind of uniformly across? And then there is a long discussion about CEOs' motivations, and a lot of it is in behavioral social psychology literature, so I almost think you've got a second paper there, or maybe a first paper to think about, what exactly can we learn from data about motivations? Because I always, in economic research and in leadership, I'm learning, the more you think you know, the less you know about actual motivations. So I'll speak for myself. I won't speak for others. So that was one reaction as well. Okay, so let's see. So Zifeng, let's see. I'm running out of time, so I'm going to move the pace up a little bit. So Zifeng, you and your co-author found a positive relationship between technology spending and performance, and you've determined that it appears to be driven by larger banks. One of the phrases you used was adding technology out of necessity, and so I'd be really interested to know, what is that? Can we unpack that? Are you thinking about technology that banks kind of have to invest in because, as you mentioned, because of customer and client preferences? Could it also be because of requirements that were led by regulatory changes? And I noticed it was around kind of 2011, 2012 that I did see a little bit of an uptick there. So that I wonder if that could be driving it, especially for the larger banks. And then the other question as an economist that came to mind was, what is the counterfactual? And by that, I mean, what would happen if banks didn't choose to invest, and in particular, if community banks didn't choose to invest in the technology that they did, what would that look like? Because you did point out that you were seeing findings on income, but that wasn't being converted into profitability. Is there something going on with kind of obligation to invest where there is no other way? If there had not been investment, what would the returns have looked like? And it could have been disastrously worse. So I think it could use a little bit more modeling technology, more econometric structure on that to produce a model that you can actually pipe through and do a counterfactual exercise. I tend to be drawn to those myself, but I understand if you choose a different way. Okay, and then another item that came to mind is technology investment. So it looked like you were looking at spending, and so I was curious to know if there were decompositions that you could do of the types of tech spending that could help explain, distinguish spending from investment. Okay, and then finally, this is a kooky idea that maybe we should talk about at the break. That I was thinking Lewis's idea could be used in your paper as an identification method by looking at the degree of tech focus of the CEO's university to see if the CEO might themselves have a proclivity towards technology and tech investment. I'm the discussant, so I can kind of toss up any ideas, right? Okay. And to wrap up, I wanted to name a couple of themes. So not surprisingly, I would say, as evidence in these papers, community banks do appear to show continued resilience, occupying a niche that's distinct from larger banks, and that technology for community banks does have a nuanced role that I think it would be beneficial to unpack. And I would expect that the business models of the institutions are driving a lot of those differences. Bank leadership matters. We see that really across at least 3, if not 4 of the papers here in expected ways, but also maybe less obvious ways. And then so I would conclude with a question. I'm seeing showing up in at least a couple of the papers in this session some human elements, and I would ask what human elements of community banking are important for us to understand more deeply. Is human interaction itself more than an informational advantage? And in particular, in a tech-focused, tech-forward world, is human interaction actually, in some ways, a strategic advantage? So Thank you.